Hello, my name is Sam Stovall, and I'm Chief Investment Strategist at CFRA Research. Thank you very much for tuning into this impromptu webinar discussing our 2020 foresight, specifically the Corona collapse, our equity outlook for the rest of this year. If we take a look at the first slide, what we'll see is what our forecast was for the beginning of 2020. And we thought that we would end up seeing a mid to high single-digit price appreciation. What we have experienced, however, gives us reason to maintain this target, but being a 12-month target, now it's what we expect to see between now and the end of March of 2021. The headwinds we're all familiar with. First off, the negative January barometer. The old adage says, as goes January, so goes the year. And historically, when the market has been down in January, we've had at best an uncertain remainder of the year. Double downers are a negative January and February as we got this year. History then says, watch out, because 60% of the time, the market has been in negative territory for that entire year. Headwinds continue with the uncertainty of the COVID-19 magnitude. How long will it last? How weak will the economy get? How low will corporate earnings plunge? Then this is what investors are trading on, this uncertainty as to how bad the COVID-19 situation will become. As a result, investors are increasing the likelihood of a recession. Obviously, economists are doing the same, but based on limited data, we don't really know exactly what will befall the economy when all is said and done. We're also looking at decelerating earnings growth and PE contraction, but believe it or not, there are some tailwinds. We've been hearing of Congress pushing through a $8 billion fiscal stimulus package for medical testing and so forth. Also discussions of a near $1 trillion fiscal stimulus offered by the president to help put money back into the hands of those people who have lost their jobs because of the self-quarantine. We've also had the Federal Reserve reduce interest rates by 100 basis points, 1 full percentage points to essentially zero. We think that we'll likely see some relaxed regulations on banks and reinstated trading restrictions on short sellers. We also remind investors that the dividend yield is above the 10-year yield, and historically that has been very favorable for stock investors. Finally, recently, the percent of the 148 sub-industries in the S&P 1500 has not been this low since the Friday before the market decline that ended in 2009. So let's take a look at the next slide, which raises or answers the question, why were so many people taken by surprise? History is a great guide. It's never gospel. Mark Twain said that it might not rhyme, might not repeat, but it frequently rhymes. In the case of the coronavirus, it was more like the singer of the national anthem that forgot the words. Historically, whether you go back to SARS, swine flu, MERS, Ebola, Zika, the stock market's performance, 30 days, 60 days, 90 days later, every single observation was positive. Even the most recent observation, the 30 days after the first US case was recorded for COVID-19, the market was higher by 1.6%. However, the market then began to exhibit the glide path of a crowbar, which we are still going through in that second 60 days. So obviously, history did not serve us very well. How far have we fallen? Well, let's take a look at the next slide. And what we see is the corona-induced carnage that has occurred since the February 19th top. Yes, February 19th was an all-time high less than a month ago. What we found was that in only 22 days, 22 calendar days, the S&P fell into a bear market mode, which was the fastest decline from a peak to the minus 20% decline threshold since World War II. Every sector was in negative territory. The traditional defensive groups, consumer staples, healthcare, utilities, telecom services, the old AT&T, Verizon type companies were among the better performers. Doesn't mean that they rise or did rise this case. As in the past, they fell, they simply fell less than the more cyclical sectors such as industrials, financials, energy. In addition, mid and small cap stocks fell the furthest in terms of value and size, mainly because they normally do. In terms of the best and worst sub-industries, not a surprise here. Again, those that relate to food, consumer staples, healthcare, gold are the ones that tend to hold up the best. Whereas the ones that are related to the consumer oil or to oil and gas are the ones that were hit the hardest. So now the question that most on the financial media are asking is, how bad could it get? First off, remember that when you do watch financial media, their goal is to raise your adrenaline level so that you will then remember what you were doing when you experience this rush of adrenaline. Their goal is to get you to tune back in later on to see whether the world really did end at midnight as they had foretold, so at least you can revisit their advertisers once again. So let's take a look at the next slide. How bad could it get? And looking at the bear markets following the bull markets, basically dividing them into two parts. What was the median duration? How long did this bull market last? Those that were below the median were called short. Those above the median were called long. Ditto for percent gain. By how much did this bull market go up? Was it above or below the mean? If so, it was called small or large. And then lastly, what was the valuation at the peak of the bull market? If the PE ratio was below the median, then it was called cheap. If it was above, it was called expensive. Unfortunately, this bull market was not only the longest, arguably, since World War II, but it also was the second greatest gainer and was the second most expensive. So all three of these categories are to the right of the median, and the average bear market that ensued these long, high growing and expensive bull markets ended up anywhere between -38 and -41%, or what I would call a mega meltdown, which is a decline of 40% or more. Let's take a look at the next slide to find out from a fundamental perspective if this is something that likely could be repeated. Right now, the S&P Capital IQ consensus estimates are pointing to $168 in earnings for 2020 for the S&P 500. At a multiple of 14 times, that points to 2351, which is 30.6 below the all-time high of February 19th, and 1.5 percentage points below the most recent low close. But what if we end up repeating history? Well, what we found is that earnings during recessions, on average, fell 10%. And the last PE multiple, or the lowest PE multiple in the bear market of 2008, hovered near 10. So if we were to say a 10% decline in earnings combined with a PE multiple of only 10 times, that would imply, but obviously not guarantee, that we end up with a decline that rivals that of 2007 through 2009, or in the upper left of the middle grouping, a -56.4%. So this basically says, how bad could it get? What is the worst case scenario? But interestingly, as we see in the next slide, the economists are not really expecting this to be a multiple quarter slowdown, as has been the case with many other recessions. Let's remember the recession that accompanied the financial crisis started in December of 2007 and ended in June of 2009. Well, we're not even looking for more than 1/4 of GDP decline currently. Our economists are saying that we'll probably end up with 1.8% growth. This is compared with the 1.9% estimate that they had in the middle of January, just before the first case of the coronavirus. Still looking for some growth in the first quarter because of the hoarding that is going on by consumers currently. Second quarter is where we'll likely take it on the chin. Original estimate was for a gain of 2.6%. Now we're looking for a decline of 2%. Yet because the coronavirus self-quarantining, et cetera, is expected to be concluded sometime in the third quarter, expectations are that we could see some delayed expenditures being pushed off into that third quarter. And instead of getting a 2.5% gain in GDP, now the forecast is for a 3.7% advance. And also fourth quarter is likely to see an improvement over the original estimate. If we go to the next slide, we'll also see that around the globe, it is not anticipated that earnings will go to zero. Granted, if you take a look at the 2.4% that is currently being forecast by analysts on Wall Street for the S&P 500, that's down pretty dramatically from the 7.9% forecast seen at the beginning of the year. If you look to the developed ex-US BMI, which stands for Broad Market Index, or basically the developed international countries, 4% gain is what is anticipated now, but that's down from the 10.5% forecast at the beginning of the year. Lastly, emerging markets are expected to post 7.7% earnings gain this year, but that too is down dramatically from the 12.7% growth anticipated at the beginning of 2020. So now the question begs, okay, well then do I simply run for the hills? That would probably be the worst thing that one could do. Most investors that I know might be prescient when it comes to selling out and avoiding some further losses. But because the decision was made from an emotional perspective, they ended up getting back into the market at a level that was higher than where they got out, because they didn't want to be tricked by what's called a bull trap, where the bears trap the bulls into rejoining. So typically, investors tend to be good market timers on the way down, but horrible in terms of getting back in. Also, usually it's best to be greedy when everybody else is fearful. Take a look at the next slide. For example, looking at the price to earnings ratios for the 11 sectors in the S&P 500. Currently, you see the numbers on the left-hand side. Well, what has been their average going back 20 years, and how cheap, meaning discount, are they trading relative to these absolute PEs? What we see is that 8 of the 11 sectors, as well as the S&P 500 value component, are trading in double-digit discount mode. Many of these are in 20 and 30% discounts to their averages over the last 20 years. Interestingly enough, but utilities are expensive, trading at a premium of 5 times. And when compared with the S&P 500, the relative PE ratio, we find that 4 sectors, energy, financials, healthcare, and industrials, are trading at double-digit discounts to the relative PE, yet groups like consumer staples and utilities are trading at double-digit premiums. So our advice would be very careful about jumping into those groups that have been strong performers currently, because you might end up giving back much of that gain once the panic subsides. So let's conclude with a couple of ideas. Going on to our Market Scope Advisor platform, what I did was a very simple screen looking for those companies that have buy or strong buy recommendations by CFRA equity analysts. Let's take a look at those stocks that offer a very generous dividend yield, in the case here of 3% or more, but at the same time have a very high consistency of raising the earnings and dividends in each of the last 10 years, or what is called the S&P Earnings and Dividend Quality Ranking, letter grades of A-, A, and A+, because they have a reduced likelihood of cutting those dividends because of their superior long-term track record. But just to play it safe for ones who like to wear a belt and suspenders, we looked at the payout ratio. Show me those companies that pay less than 75% of their earnings in the form of a dividend. So if there is indeed some earnings compression, that there's a margin of safety that these companies could offer where they're not overpaying for their dividends. And then lastly, at the same time, let's make sure that we're not dealing with companies that are over leveraged in terms of debt to capital ratio. And so looking at those that are have a debt to capital ratio that is below 70% at this point. So these are some 16 companies that fit the criteria that are in the financials, healthcare, consumer staples, consumer discretionary, utility, technology. So you get the message. An awful lot of companies from a variety of sectors that CFRA equity analysts believe could be longer term buying opportunities because they have taken it on the chin, yet they now offer an attractive dividend yield with security that there's a low likelihood that their dividend would be cut, and at the same time, a very high quality ranking. So with that, I say thank you very much for tuning in. I hope you found that this presentation was helpful to you. Take a listen on April 7th when we will have a deeper dive into the investment strategy and particular sectors that we will be focusing on.